Hey everyone, welcome back to another video. In this video, I'm going to be talking about Occidental Petroleum. And this stock is down 20% this year, while the rest of the market is up 22%. So obviously it's underperforming the market. But if we look at the 5-year chart, they are currently up 16%. But that being said, over the last year, this is basically the lowest they've been, which means it could be a good buying opportunity or it could be a red flag to sell the stock. So in this video, I'm going to try my best to figure out which one it is. But for starters, some recent news about Occidental Petroleum is that they've been expanding their operations through a recent acquisition of CrownRock for $10.8 billion, which is expected to increase production by 5% in the Permian Basin. This acquisition is set to increase Oxy's oil and gas output to 1.32 million barrels of oil per day. Occidental Petroleum also has been making significant progress in reducing the debt on its balance sheet. So far, the company has reduced debt by about $3 billion with the goal of $4.5 billion in debt reductions set to be achieved by the end of the year to allow for more future shareholder returns. But that being said, Oxy has also been facing some recent challenges. The acquisition of CrownRock has introduced some increased scrutiny on the company from regulatory authorities, which could end up delaying the completion of the deal. The company's stock price is also down 6% from its last earnings report and has been underperforming the broader market, as I said earlier. And so in the short term, OXY is expected to be volatile due to the new regulatory pressure and the current financial uncertainties. However, in the long term, the reduction of debt on OXY's balance sheet and its solid production outlook could potentially end up making it a strong buying opportunity. And as we can see from this article right here, it's titled 3 Value Stocks to Buy as Berkshire Hathaway Hit an All-Time High on Warren Buffett's Birthday. So Warren Buffett, obviously one of the most legendary investors ever. One of his big holdings now is Occidental Petroleum. Berkshire has maintained a sizable holding in oil and natural gas exploration production company OXY. And if I scroll down here, we can see why they highlight that Oxy might be a good buy or sell. Right here, they point out that Hathaway owns 27.3% of Oxy, commonly referred to as OXY. That stake is Berkshire's 6th largest public equity holding, worth more than $14 billion. And right now, the stock is hovering around a 52-week low. So if Buffett bought the stock earlier, and right now they're hovering at around a 52-week low, then if they continue to produce good production and strong financial outlook, then obviously the stock could increase from here. Oil prices affect the fortunes of the entire oil and natural gas value chain, but currently they've fallen below $70 a barrel to its lowest level so far this year. The $70 is significant because OXY has been basing some of its key decisions around the assumption that prices will be at or above the $70 level. And so the $12 billion acquisition of CrownRock, for example, is based on cash flows that or prices that are expected to be at or higher than $70. So the lower the oil price, the lower the free cash flow, and the worse the acquisition could look. But that being said, OXY has done an excellent job improving the health of its balance sheet by paying down debt. And right now, with a dirt cheap price to earnings ratio of 13.5 times earnings and a price to cash flow or price to free cash flow ratio of 13, OXY could fall from here and it would still be considered cheap if you bought it right now. So it could be a great time, as this article highlights, to scoop up shares of Berkshire's top energy company on sale. And as we can see from these financial statements, this is their income statement from their first quarter of 2024. They posted revenue of $6 billion, which was down about 17% from $7.2 billion. And we can also see they had net income of about $718 million, which was down about 27% from $983 million. Then for their second quarter of 2024, we can see their income statement right here where they posted net revenues of $6.8 billion, which is up 1% year over year from $6.7 billion in the second quarter of 2023. And we can also see that for their net income, they posted a 65% gain from $605 million to $1 billion of net earnings. We can also see that for the first 6 months of the year, their revenues have declined by about $1 billion from 14 billion to 13 billion, but their earnings have increased from 1.5 billion to 1.7 billion. So that's obviously good news because it means that somewhere along this line, their cost of revenues their cost of revenues and their cost of operations were smaller than their cost of revenues. And so as a result, their earnings were able to increase. Then lastly, to end off the video, I wanted to do an intrinsic value analysis to calculate Oxy's intrinsic value. I'm using a growth rate of 43% because their free cash flows have grown. This should say 2018, but from 2018 to most recent year, whatever that is, 2023, 2024, whichever I use for this. But over the last 5 years, essentially, their free cash flows have grown from about $1 billion to $6 billion, which is a 43% compounded annual growth rate. To calculate the discount rate, I'm using a WACC metric of 7.86. You can see how I got that using this calculator right here. And we can see that currently on their balance sheet, they have a net debt position of about $19 billion after subtracting cash. And they have about 900 million shares outstanding. So right now, intrinsic value per share is estimated to be about $516 per share, which puts Oxy at a significant undervaluation compared to their estimated intrinsic value. But keep in mind, obviously, it's a pretty optimistic growth rate of about 43% for their free cash flows, although they've grown at that rate over the last 5 years. As the article highlighted, the oil and gas industry is very cyclical, and the success of these oil companies is predicated on the price of oil and gas. So if oil and gas prices don't rise, then we shouldn't really expect free cash flows to rise at 43% either. But if they do, then OXY could be presenting a really strong buying opportunity at the current share price. So right here, we can see OXY's competitor industry analysis comparing them to the rest of the oil and gas industry, particularly to ConocoPhillips and ExxonMobil. Compared to those two companies, OXY has the best gross profit margin and they have the second best net profit margin. They have basically average return on equity here, similar to ExxonMobil, with ConocoPhillips having the highest. They have a low PE ratio of about 15 times earnings, as do ConocoPhillips and Exxon. They also have low PE ratios. They have the lowest price to cash flow ratio, which, as you might know, for price to cash flow ratios, if you see a company that has a lower price to cash flow ratio than the rest of the industry, as this ratio increases to meet the industry average, it's possible that their share price could also increase in accordance with the increase in their price to cash flow ratio. But obviously, these are only two companies, and ExxonMobil's is very high. So if we average them out, it could mean that OXY is actually decently close to average, especially if we incorporate all the other oil and gas companies in this industry. But that being said, we can also see the dividend yield is about 1.21%. So for every $100 you invest into petroleum, you're getting paid $1.21 per year. It's the lowest out of the three companies. So based on this analysis, if you're looking at profit margins at the gross level, you'd want to give it to OXY. But for basically everything else, ConocoPhillips and ExxonMobil are doing a little bit better than Occidental Petroleum. And so to end off the video, I wanted to compare OXY to some of the other companies we've looked at on this YouTube channel so far. We can see that OXY hits the top of our intrinsic value list for share price compared to intrinsic value, trading at 10% of its estimated intrinsic value. There are a lot of oil companies on this list, and then we can see the other two companies on here that aren't oil companies, Google and EPAM Systems. Then we can also see growth rate. Oxy had a historic growth rate over the last 5 years for free cash flow of about 43%. Their dividend yield was only 1.21%, so it wasn't good enough to get them onto this table. We can also see that for profit margins, OXY's profit margins weren't good enough to get them onto these tables, but we can see the top 5 companies that had the best gross profit and net profit margins. For year-over-year revenue and earnings growth, we can see that for the second quarter of 2024, OXY is the only company we've looked at so far at 1% revenue growth and 65% earnings growth. But for the first quarter of 2024, we can see that they had negative revenue and earnings growth of negative 17% and negative 27%. And you can see the other companies here that have showed up on this list. So far, it looks like OXY hasn't really been able to show up on any of the quarter revenue and earnings growth tables that we've created here, but you can see the rest of the companies that showed up here. Unfortunately, OXY is not one of them. So quarter to quarter, it looks like they aren't really outperforming other companies in the market based on earnings or revenue growth. Lastly, if we compare OXY to other companies based on their stock performance over the last 5 years, OXY is up 16%, which is really not that good compared to the other companies on this list. We can see that NVIDIA is doing the best at 3,400% returns over the last 5 years. So let me know in the comment section down below what you guys think of this video and also of this company, OXY. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.